As a beginner day trader, you should focus on the high probability entries. And as you become more experienced, you can trade the low probability trades. But where are the high probability entries? Here's the chart for GBP USD 5 minutes on July the 28th, 2022. This is a very normal day in terms of the chart. But where are the entries that give you the higher probability? Let's find out. First, let's find out the levels and the London Open. We can also see that overnight into London Open, we have this value zone. So the market after London Open is within this range. After the London Open, the market has been testing this top range quite a while. Do you want to trade down immediately? The answer is no, because still after London Open, it's an uptrend mode, because this is a higher high comparing to the previous highs. So it also has the probability the market will go down, test a little bit, and then reverse, and then going up. So the best point to enter your trade is here. Basically, the market tries to break this small range, and then failed, pulls back, but the pullback is very small, this bull bar. Immediately after it is a bear bar. This bear bar's body leaning towards the downside of the candlestick. So this gives you a higher probability entry. So after you enter, you should target your profit at the value zone here. After that, the market didn't respect this value zone. Instead, it penetrates this value zone. So it is a breakout. After the breakout pulls back, you will see a high probability entry here. The breakout here with consecutive bear bars, and then pull back with the bull bar, and then this bear bar has a higher probability as an entry. So you need to short after it finishes. And then you can see the market didn't go down immediately. Instead, it pulls back again with this bull bar, and then goes down, and then pulls back. And then after the third push up, there is other high probability entry with this bear bar. This bear bar's body accounts over 60% of the candlestick. So this is a high probability entry. But if the market pulls back again and then give you another good signal bar, probably you don't want to trade short because the pullback has lasted for so long, so the strength of downside is weakened. And also if you're in a trade by this pullback, probably you want to get out of your trade. Then the market goes down. However, it pulls back here with consecutive bull bars. This pullback is bigger relatively to this leg, and this leg is smaller than the previous leg here. So you know that the downside strength is lowered very much. Then you notice the market has been ranging here for quite a while into the New York Open. At this time, you can see the whole picture. The market goes down and stopped. So there's a high probability the market will reverse, but in terms of how much it's going to reverse really depends on the strength of the upside. What we can see is that there are 3 pushes down, but didn't go down further. Instead, it goes up here. This high is higher than this high, so it seems to be a reversal setup. But this reversal is not very strong because this is not the traditional pattern for the reversal. Not the V, not the double bottom, double top, or the head and shoulders. Then you can see the market pullback here. So this pullback is relatively large comparing to this leg up. So the strength to upside is weakened. And also at the same time, this bull bar, you can see that it is not a very good signal bar because the body accounts less than 60% of the whole candlestick, and also the tail at the top is larger. So this is not a high probability entry. You can argue that there is another bear bar here. Do you want to trade down? Probably not. This is not higher probability entry because given the context here, we are making a higher high. It seems to be a reversal, and then the downside pressure has been lowered. So here, it is not a high probability entry, so you don't want to trade it.